Hello, everybody. This is Jason Wink again, and this is a little video update as to what's shaking out as we close out the week before the Labor Day weekend. It is September 2nd, about 2:15 p.m. Markets will close in about 2 hours, and so far, things are not looking good in the world of the stock markets today. Kind of see here, this is from Google Finance. Markets started off down and then stayed down, and as I'm recording this, they're falling even further. This is important because maybe in my last video that I did, I pointed out that the market was kind of at a critical juncture and estimated that the probability of the market falling rather than rallying seemed to be a little bit higher. That was my guess by looking at the information that I had available to me. And we can see that here. There's some of the lines that I've drawn in on these charts. And I was really hoping, like most investors, that once we got above 1,200 on the S&P, that it would break above this support and resistance line and perhaps rally up into some new highs. But it has not done that. Instead, it bounced kind of right off. It has fallen down to where the S&P today is about 1,175. So things are not looking good from a momentum standpoint. And then, there's been a lot of economic news in the last week. None of it's been good either. Anything from home sales to unemployment figures, nothing has been positive to this point. There has been some additional talk that the Fed may try to do some type of easing again. Be curious to see exactly what that entails. We can see that in the short run, it's made long-term bonds. So here's a look at kind of the prices of long-term government bonds. The prices are going up because the yields are going down. So in their speculation that the Fed may buy more long-term treasury bonds, when bonds are bought, it drives the prices up and the yields down. You can see that here. The prices have really just skyrocketed, and they're right about the same point they were at the peak of the financial crisis in 2008. And there's some wisdom on Wall Street that suggests that the bond market is a good indicator of where the stock market really will go. And so you can see that when bonds were kind of rallying back in 2008 up to the very beginning of 2009, the stock market actually dropped another 30% right after that big peak. So I don't know that that's necessarily going to happen this time, but again, the momentum is certainly waning there. When we look at different markets, so I'll just take a peek. For example, here is small cap stocks, and we can see much like the large cap counterparts when I showed the S&P 500, they too have fallen substantially, and we can see that while they're still off their lows for the year, they're not far off their lows after today's drop. We can see that really only about another 3 or 4% decline in small cap stocks will be at their lowest point for the year. So virtually everything is negative, anywhere from a few percent to over 10%. If I go back to my Google snapshot, for those who are keeping track of where the market's at, this is a little chart that makes it easy to see the performance on a year-to-date basis. We can see that the S&P, for example, right now is down about 6.6% for the year. And if we compare that, for example, to the Dow, I think that's performing slightly better, but is also now down about 3% for the year. The big culprits, though, so far this year have been things like small cap stocks. And so when I plug those in, you can see that small cap stocks are actually down 12.5% for the year. And mid cap stocks, kind of the same story. If I plug those into this chart, we'll see that mid caps are down 8%. So when we look at the S&P, you can see, oh, it's down 6.6, so the Dow is only down 3. It only really tells part of the story because most people are going to have a portfolio that has stocks of all different size. And when you do that, you can see that typical stock portfolio is going to be down pretty substantially. If we start integrating things like international and emerging market stocks, those are these last two I plugged in, those are down 11 and 13% for the year. So again, any type of globally diversified stock portfolio, by and large, is going to be down probably in the neighborhood of 8 or 9%, if not closer to 10% for the year. And that's after a lot of these indices were up in the neighborhood of 9 or 10% just a few weeks ago. We can see right around this area was sort of the peak for the year, when a balanced sort of growth-oriented portfolio may have been up as a whole somewhere in the neighborhood of 5%. And obviously now, as I said, it's probably closer to being down in the 8, 9, 10% range. As far as expectations moving forward, if I consult back to kind of some of the momentum that's happening out there, really what, again, if we look at the very long-term kind of trends in the market, they're not positive. I've shown this before. This is something called moving average convergence and divergence. You can see that the black line now has breached the red line, which basically means that the momentum is clearly breaking. And the last time this happened, and again, doesn't always work out this way, but the last time that happened was in October, November kind of 2007. And so we have to be very, very careful. I mean, anybody who's going to be overly aggressive right now, I think, runs a major risk of getting burned, only because the last time the markets set up like they have today, the markets preceded that momentum shift by dropping from 1400 all the way down to 666 at their lowest point, actually, in 2009. So a greater than 50% decline. As far as the moves that we're making for clients who are curious what updates we've made, I did write a post just a couple days ago. In one of our tactical asset allocation models, we moved literally very, very heavy to cash before the month of August started, which has helped significantly in mitigating the losses of yesterday and today, which, if today finishes where it is right now, it'd be a 2-day start to September of a 4 to 4.5% decline. So obviously it was smart to have sidestepped some of that, but there's still a lot of month left, and so we'll see where that goes. In other portfolios that we have that are designed to get defensive, we are very heavily in cash. We have different types of portfolios, obviously, or models that we use, but virtually all of them that have been that are what I call tactical in nature, meaning they do actively move from equities or growth investments to income-oriented investments or to cash, have been heavily in cash, 50 to 80% in cash now for the past couple of weeks. And so by and large, our portfolios have been very defensive and conservative, which I've kind of talked about that message. That's really the smart way to be at this point. So again, I don't think it's time to panic. People just need to be conservative, and sometimes it's okay if there's a small loss, for a month or two. It's just part of investing. We have to have a long-term perspective and know that, really to see how any investment strategy works, sometimes you need to give it 5 to 10 years, and a lot of people don't have the patience for that. The best medicine, again, is being balanced, diversified, and, in my opinion, quite conservative in times like this. Where the market is today is actually lower than it was 6 years ago. So, if someone's frustrated with not having any returns the past few years, that's common right now, and I don't know that that's going to change in the next few months. Again, a lot of the momentum is suggesting that we could be heading back into a bear market of some variety. If it does happen, I think the stop would be kind of that blue line I've drawn in, where the market would, if it continues to break through some of these support levels, it should fall, I think, down to 1100 on the S&P, which really is about a 6% or thereabouts decline from where we are today. If it doesn't stop there, things will get very ugly in the market. So we have to be very cognizant. In other words, the smart move for investors, and again, this is not personalized advice, just my take on what's happening. Be very, very conservative from here, because I do think that while there'll be some gyrations, we will find some footing again back around this 1100 level. From there, if the market falls through, people need to just completely abandon a lot of their growth strategies and look towards defensive investments. Obviously, those will be actions we'll be taking automatically. However, now I don't think is the time to do that, because there is still a decent chance that we'll find some footing and the market will go up. The probabilities, though, just are getting worse as the momentum wanes. So not to try to make anyone panic going into the weekend. Obviously, you just want to be very cautious out there. Hope everybody does have a safe weekend, enjoys sort of the last hurrah of this summer. For those who have kids going back to school, best of luck to them. And I'll be back next week with probably some more video updates on kind of how we see the markets continuing to develop, and also perhaps some written blog posts versus the videos like I've done so much in the past few weeks. So again, have a great weekend. Thanks a lot for checking out this video. If you have any questions or comments, feel welcome to use the comment feature below. And one more thank you too to all the people who filled out our survey. It's immensely helpful to me. I really appreciate it. Have had hundreds of people fill out the survey. About half have been clients and about half are non-clients. So it's always helpful to get the feedback, not just from our clients, but also from others who are reading our blog and hopefully getting some good value from it. Have a great weekend. Thanks again.